ETFs or exchange traded funds are super popular for their benefits, diversification, lower costs, and stock-like trading flexibility. Around 1.5 million Australians, or 6% of the population, invest in them. But have you ever thought about the total cost of owning an ETF? The management fee, you may say? They're more than that. In this video, we're going to talk about the total cost of owning an ETF, including the most familiar cost factors and the implicit costs that are usually overlooked. By the end, we'll discuss which cost factor matters more when choosing an ETF that best suits your holding period and your trade size. 2 decades ago, expense ratios between ETFs varied by 0.1 to 0.2%, but now they differ by just 0.01 to 0.02%. And this means that other cost factors are now more important when choosing an ETF. The total cost of owning an ETF includes the holding costs and transactional costs. The holding costs cover the management fee, portfolio management efficiency in attempting to match the index returns, and any offset from income of lending out the underlying securities of the ETF. Because ETFs are bought and sold on an exchange like shares, investor trading costs would involve the commission, the brokerage fees to the broker, bid and ask spread, and the discount premium to the ETF's NAV. Generally, holding costs are crucial for buy and hold investors. The most obvious and pivotal fee is the ETF's management fee, also known as the investment fee or expense ratio. This is an annual charge by the fund provider, not your broker, on the total assets it holds, covering portfolio management, administration, custodian services, and so on. For instance, VAS has a management fee of 0.07%. If you have $10,000 in VAS, you'd accrue about 2 cents in fees daily. This fee is deducted from the fund's assets and reflected in the ETF's daily NAV price. Since Vanguard introduced its first ETF, VTI, advocating low-cost index ETF, there has been a fierce price war between ETF providers. The annual study shows average management fees have halved in 2 decades from 0.93% of the total amount invested in all funds in 2000 to 0.41% in 2020, saving investors $6.3 billion in ETF management fees in 2020 alone. Although the difference of management fees by similar funds are small, we should still compare management fees because, number one, is probably the most variable cost investors can control as it's easily found on the fund page. High investment fees can significantly impact returns. ETFs with lower fees tend to match market performance better. As this chart shows, ETFs with a 0.1% management fee almost match the S&P 500's performance, and ETFs with 1% management fee are significantly lagging. Next, let's talk about fees that is involved in portfolio management efficiency. These includes costs like sampling the index, rebalancing, turnover, and any cash drag due to the fund structure or tax. Index fund managers must build the fund to mirror their target index. This can be challenging, especially for larger indices like the S&P 500 than smaller ones like the Dow Jones. It's kind of like buying groceries based on a shopping list, but in this case, it's buying stocks, bonds, or other securities. It's more likely that you'll miss something from the shopping list if it's too long. Once the fund is sampled, managers must constantly adjust it to match the index as it changes. Every index has its own methodology or requirement to include certain securities. Certain companies might be kicked out of this index and new companies will be included. And this turnover process of an index requires the index fund manager to keep up the pace, selling some securities and buying new securities. Some fund managers will face more challenges, such as equal-weighted index funds. The fund manager must periodically rebalance the portfolio to ensure all the securities are equally weighted, and there are costs as well as profits involved in those processes. In general, an ETF with a higher turnover rate will incur higher transaction costs. Capital gain tax will be triggered, which would erode returns over time. For ETFs that invest in international markets, the fund manager must deal with different tax rules for the countries and the stocks that they hold, and these tax rules may be favorable or unfavorable to the investors. And some ETFs earn revenue by lending out their underlying securities to short sellers, and this extra income helps offset the ETF's fees, described as the best kept secret in the ETF industry. Although the detailed information might be hard to find, but these returns do benefit investors. Among all the holding cost factors, investors can access information on management fees and sometimes the turnover rate. Other holding costs related to portfolio management efficiency are usually unintended and can sometimes be difficult for investors to measure, other than the tracking difference and tracking error. So what is the tracking difference? All else equal, index ETFs should produce returns that lag their benchmarks by an amount equal to their management fees. Take VAS for example. VAS currently charges an annual 0.07% management fee. If the ASX 300 index 10-year return is 8.04%, VAS 10-year return should be 7.97%. But we can see VAS actually has outperformed the index by 0.01%. Could it be the return from securities lending? Maybe. Or it could be from the process of turnover. Tracking error, however, measures the standard deviation of the difference between an ETF's return and its benchmark's return over time. So tracking error indicates how consistently, closely, or not an index ETF follows its benchmark's performance. The lower the tracking error, the better. A lower tracking error indicates better performance alignment with the benchmark. A higher tracking error means a higher risk of being out of sync with the target index performance. We can see from these three bond ETFs, MUB has the most significant tracking error, meaning it's more likely to travel far from the intended index performance. Now let's move on to the transactional cost. The most obvious transactional costs are trade commissions, also known as brokerage fees, paid to brokers. Most of the time, these commission per buy or sell trade is quoted as a flat dollar fee, sometimes on a percentage basis. If you're looking for a low-fee online broker in Australia to buy ETFs, this video can save you a lot of time. For the brokerage fee, we just need to keep 2 points in mind. Number one, the frequent trading cost. The more you trade, the more you'll pay in commissions. Number two, commissions are usually a flat fee, so the cost as a percentage of the trade is higher for smaller trades and lower for larger trades. For example, a $5 fee on a 500 trade is 1%, but on a 5,000 trade is just 0.1%. Next, let's talk about not so obvious transaction costs, the bid and ask spread. Let's say you are a potential ETF buyer. When you try to place your buy order, you will find there are already buyers who have made the bids from the lowest to the highest and sellers who have put in their offers or asked prices which they are willing to sell. The most expensive bid by the buyer would be the best bid, as that buyer obviously is very eager to buy. The lowest ask price from the sellers is the best ask, as he's desperate to sell the shares even at a lower price. The difference between these two prices is commonly known as the bid and ask spread. Generally, there are three main factors that drive the bid and ask spread. The ETF's volume or turnover. If an ETF turns over quickly, the market maker carries less market movement risk, so they can set the spread tighter. You may ask, what is the market maker? How does the ETF's creation and redemption work? I would say it needs another video to explain it properly. For now, you can just remember quick turnover or more volume equals tighter spreads, which is beneficial to investors. The second factor is the volatility of the underlying securities. This is often affected by the overall market volatility. In fast-moving or highly volatile markets, market makers need to provide larger spreads in case the market turns against them. So, volatile markets equals wider spreads, bigger costs to investors. The third factor is the liquidity of the underlying assets in the ETF. So, higher liquidity equals tighter spread. For easier comparison, we can calculate the bid and ask spread percentage by using the difference between the ask price and the bid price divided by the ask price. Let's say an ETF's bid price is $9.95 and offer price is $10. The spread as a percentage is 0.5%. And this means a buyer who buys the ETF acquires the stock at $10 market price and immediately sells it at the bid price of $9.95, either by accident or design, would incur a loss of 0.5% of the transaction value due to its spread. The purchase and immediate sale of 100 shares would entail a $5 loss, while if 10,000 shares were involved, the loss would be $500. Let's use this method to test VS, a large cap liquid ETFs versus VSO, small cap index ETF. After we do some quick math, VS definitely has tighter bid and ask spread. The last and possibly least accessible cost factor is the ETF's premiums and discounts to NAV, given the fact that it's difficult to know the timeliness of intraday net asset values. The net asset value NAV is the value of all assets in the fund minus liabilities divided by the number of shares. It represents the ETF's intrinsic value. When the market price of an ETF is above NAV, it's overvalued, but in ETF terms, it's said to be trading at a premium. When it trades below NAV, it's said to be trading at a discount. Most ETFs have small discounts and premiums. A good example of this is an ETF that tracks the S&P 500 and whose market price might not swing more than 0.2% from its NAV. Like I said, it's not visible for investors to see if the current ETF's market price is traded above or below its NAV, but the point here is to be aware of the risk involved. And stability of the premium and discount is important to consider, which is a distinctive issue for closed-end funds like LICs. Which cost factor matters more depends on your holding period and the average size of your trade. The longer the holding period is, the more the holding costs tend to be the strongest cost factor. The accessible variables like management fee, tracking error should be our primary consideration. The smaller the trade size, the more attention we need to pay to brokerage fees and spread. For shorter holding period, transaction costs seem to be more important, therefore spread, brokerage fees, as well as stability of the premiums and discounts. Well, did you know that there are so many cost factors that will contribute to the total cost of owning an ETF? If I miss anything, please comment below. My name is Irene. I'll see you next week. Bye.